Hello and welcome to Chapter 9. In Chapter 9, we're going to discuss long term liabilities. If you recall, what we're doing now is we're actually on the liability side of the balance sheet. We're looking, the last particular discussion we had was about short term liabilities or current liabilities. Today, we're going to talk about long term liabilities, and there's really probably four long term liabilities we're going to focus in on: notes payable, bonds payable, mortgage payable, and capital leases. And we're going to have a little bit of a discussion about each and kind of get you exposed to them. So here's our learning objectives. We're going to talk about debt securities and which they are issued at, why they're issued at the markets. We're going to talk about the accounting for long-term debt, particularly bonds, but both bonds and notes payable. We're going to use the straight line method to account for a premium or discount amortization of a long-term of a bond in particular. We'll talk about the after-tax cost of financing with debt and explain financial leverage. We'll compare and contrast operating leases and capital leases, and we'll talk about some ratios that businesses will look at their long-term solvency. In other words, can they pay their bills on a long-term basis? Uh, a couple things we want to touch on first. Long-term debt typically is divided into either bonds or notes payable. And you have some other things that are associated with it, such as debentures and capital leases. Capital leases is also another long-term debt. But notes payable are typically things that you would sign with the bank. They're not huge dollar amounts. They're significant, but they're not huge dollar amounts. And an individual bank can handle a notes payable. And the next thing is a bond payable. And bonds are going to be much larger term, much larger dollar amounts. And they're going to go into an open market where a bunch of different people can buy them, just not one bank. So let's say you wanted to borrow as a business, say $100 million. Well, you won't go to one individual bank and borrow $100 million. You would borrow it through a bond and you would do an issuance of bond. And we'll talk about that. That's a little distinction between the two. Um, both have both are contracts. All debt contracts are a contract, and they have a face value, or which is sometimes called par or principal, and it's going to be repaid at maturity. And typically, with both bonds and notes payable, more often than not, you're only paying principal over the term of the note, and then you are paying the amount due at the end. So it's a little bit different than what you might see with, say, an installment note, where you pay both principal and interest as you make payments. That's a distinction between notes payable and bonds payable, and say an installment note like a mortgage or a car payment. And there's going to be an interest rate, and sometimes it's called a stated, a coupon rate, or a contract rate that you're going to pay. So obviously, you don't get money for free. I'm not going to spend a bunch of time on this slide with all these terms. These are terms out of your text, but I wanted to make certain to leave this slide in the presentation so you could spend just a few minutes and read through each one of these to make certain you have a foundation for what we're going to talk about next, and you don't have to pull your book out. So you might want to pause the presentation here and read just these definitions and make sure you have a good understanding of those before you proceed in our discussion. When we sell new debt securities, we're going to do it through notes or bonds, borrowing. That's the way we're going to do it. And it's a way for business to get money. And it's maybe at a lower cost than issuing equity, which is basically shares of stock, either common or preferred stock. Underwriters are the group that help you, typically more with bonds than with notes, because notes is going to be a simple bank, and they can be secured or unsecured. Secured would mean that there's maybe an asset behind it, like a land or a building. Unsecured does not have anything. Callable or non-callable means that the lender or whoever or the bond issuance actually can be called. They can say, "Oh, we're going to call that in," or not callable, which means you have a little bit more power. And convertible might be that they're going to convert the bonds to another type of bond, or they can convert it to common stock. And one of the big things that you want to look at is the credit standing and the borrowing in the business and the current credit markets. All these things go in to determine your market interest rate. Now let's use this as an example that we can think of. If you have if you have really good credit and you go to Toyota to buy a brand new car, they might be willing to give you 0% interest down. But if you have poor or marginal credit when you go to Toyota to buy a car, they might not even grant you credit. So you might not be able to buy a car and pay a 0% interest. You might be forced to some of these like these car lots that have that I might call them fly by night car lots, but maybe Car Mart or something like that, where you pay a subprime amount of money. You pay a way a lot more money for your interest rate at those car lots than you would others. That has the same. It's the same kind of character within businesses, but they're rated based off of their ability to pay. Now, when you sell a bond, there's really three types. You'll sell it at a premium, at par, and at discount. And a premium says that the yield or the interest rate is really what I would prefer to say here is less than the stated rate. So you have to sell it at a premium. Otherwise, people are not going to be willing to buy that. And what it says is your interest expense is less than interest paid over the life of the bond. A par means that the interest rate or stated rate is the same, and the interest paid and the interest expense are equal. And at a discount, it's the yield is greater or the interest rate is greater than the stated rate, and the interest expense is greater than interest paid. So what does that really mean? Let's just use the bottom as an example as a discount. Let's say the interest rate on the bond is 8%, and the market interest rate is 9. That's really what this is telling us. So when they sell their bond, if the interest rate on the face of the bond is um, is less than, which is this number, the stated rate is less than the market rate, they're going to have to sell it at a discount. So if they're selling, say, $1 million worth of bonds, they're going to sell those bonds at $980,000. So when they get their cash in, they're only going to get $980,000 in, as opposed to the million that they had requested. So they would sell it at a discount. And that's really what this is talking about. And we'll talk a little bit more about that. And we'll look at some accounting for those transactions in the next couple slides. So accounting for the issuance of long-term debt. And you notice what this one is. This one says a corporation issues $500,000 at face with a stated rate of 6.5% and payable annually. Principal is due in 5 years. So here's what the cash flow looks like. They get $500,000 in year one, in year zero, and each year at the end of the year they're paying out $32,500, which is 6.5% times 500,000 times 12 divided by 12, which is 12 months. And it says that your interest rate is, or your interest is 32.5 per year, and in year five it's 532,000 because now you're paying back the principal. But you notice something here. It tells us that we know that even though it doesn't tell us that, they've issued this at face because there is no other amount. There's nothing else that we needed to do here. So the stated rate is 6.5 and the market rate is 6.5. So they issued this one at face or at par value. And when you record it, what's going to happen is this is the part where we talked about as a percentage of face. So if we issue bonds, $100,000 worth of face value bonds are issued at 103, that means you're selling at 103% of face value or $103,000. What that would tell you is that the interest rate on the bond is greater than the market interest rate. And the discount is the one in the bottom. It's the reverse. So you would issue this, the premium here would be 3,000 and the discount here would be 4,000. So this one would say that they issued 100,000, but they only got $96,000. Look at these two numbers, the 103,000, and even though they don't have 96,000 here, really what happened is they got $96,000 in cash, but they still owe 100 grand. Here they got 103,000 in cash, but they only owe 100,000. So let's take a look at an example. And we're going to show just simple journal entries. It's the same thing we just talked about. Graining Company issued 100,000 face value bonds with a stated rate of 8% due in 5 years. So the first one says at par, so that'll look very straightforward. This one's par. They issued them at 100. They got 100,000 cash. Par. The next one they issued at a 103. That's where this 103 is, and that's a 103. So they got $103,000, but they have 100,000 that they owe, and then they have a premium, which is going to be carried on the balance sheet on the liability side. And actually, you're going to add these two together to get the carrying value of the bond. We'll talk about that more in another slide. And then this last one says that you issued them at 96, so they got $96,000, and they have a discount. So the carrying value of these bonds is going to be the sum total of these two numbers, which is only going to be $96,000. And you can see this one was issued at a discount, which means that the interest rate on this one was less than market rate. The interest rate on this one was greater than market rate, and the interest rate on this one was the same as market rate. That's what these calculations show you. Now, when we start paying them, we can have an interest amortization payment, which is really where you're paying a principal and interest with each part of your loan. Um, but in most cases, we're going to deal only with the interest payment on these bonds, and we're going to pay the principal back at the end of the term of the bond. And we'll talk specifically about how we amortize a premium or a discount. And we're going to do calculations using the straight line method, which is very similar to the straight line depreciation. So if you had a discount of $10,000 and it's 5 years, you're going to take 10,000 divided by 5, and you're going to amortize $2,000 per year of your discount, which is really going to be an increase in your interest expense. So let's take a look. There's a second one. I touched on the straight line just a minute ago. And the effective interest rate method, I'm not going to go through the calculations on this. It's really a function of time value of money. I think it's probably a little bit beyond the scope of this course. But I just want you to know that there's something called the effective interest rate method that we will use that can be used to calculate the reduction of either the premium or the discount on a bond. So let's look at the straight line method. And when they first are going to talk about when it's sold at face, but you notice when it's sold at face, there is no premium or discount. So we don't need to worry about that. But we have to deal with it more when you have something that's sold at a premium or a discount. And if there's no premium or discount, there's nothing to amortize. But in this case, we're going to take a look at if we sold a bond at a premium or a discount, how we amortize straight line. And this is basically the same slide, so let's move on. We've already looked at this once, right? We saw that how we issued these and how much money we got, and no discount or premium, and then we got to amortize the premium and the discount. So let's look. The first one, this is at par. We sold it at par. So our interest expense is just going to be 8% times the 100,000 for each year. We're going to debit interest expense and we're going to credit cash. So this is for the 5 years that the bond is in existence. And at the end of the last year, what they're going to do is they're going to debit bonds payable and they're going to credit cash. And they're going to pay off that bond. Now, if you have a premium or a discount, which is what they're showing here, they're going to have the cost of carrying that is different. So you notice that the face value is $1 million. They're going to pay, but they issued it at a discount. So you notice here, they had $1 million, but they sold it at 990. So they sold it at 0.99 or 99, and here they sold it at 102. Okay, and so what happens is this shows you what the interest expense, because the rate's going to be the same. 100 times 0.05 gets you $50,000 for 10 years, so 50,000 each year for 10. So that's the same. Notice these two are the same. The difference is what cash they got when they sold it. Here they got 990, and here they got $1,000,002. And you notice that so the effective interest is 510 for the discounted one and 480 for the premium. Let's take a look at though how we're going to amortize that premium. And this one's going to be a little different example, but you can see we have it where they issued it at $1 million. It was 8%. They issued at 99, so they only got 99 million, so they had $1 million difference, and they pay semi-annually. So let's just kind of take a look at the numbers. If you want, you can pause and read through this carefully. Let's move to the next slide. So here's the first issuance, $990,000. I mean, yeah, 999, 99, 99,000, $99 million, excuse me. Then they have a discount of $1 million, and then they owe $100 million. But we have a discount amortization of $1 million per period, and that's what we're going to look at here, 100,000 per period. So for the discount, you have 10 periods because it's actually 5 years, twice a year. So you have 100,000 times 8% times 6 divided by 12 plus 100,000. So this is just your interest calculation, this first part. And then you add 100,000. So it looks like their interest, their semi-annual interest is $4.1 million every period. So let's look at the journal entry and how that works. And you can see Here's what it looks like. Interest expense, 4.1 million. Here's the whole amortization table. But you have 4.1 million for interest expense, 4 million that they pay out, and they reduce that contra um, liability account called discounts on payments payable for $100,000 at the end of, and so you're doing that on June 30th and December 30th, first every year for 5 years. And then when you get to December 31st at the end of the period of the bond, it's 100 million and $100 million that they're paying out. Okay. The same is going to hold true for a premium. Let's just look at it. I'm not going to read through this again. Let's just move straight to the payments. So they sold it at 102, so they got 102 million. They owe only 100 million, but they have this premium on bonds payable, which is on the long-term liability side. And what they're going to do is the same kind of calculation, but the difference now is, remember before there was a plus on that last slide with the 100,000? Now there's a minus because you're reducing your interest cost, not increasing it. So we went down from 400 or 4 million to 3.8 million. So let's take a look at the schedule. And I want to focus particularly on these journal entries. Interest expense 3.8, premium, we're going to reduce that premium balance by 2 million, and the cash that goes out is $4 million. So whoever's holding those bonds is going to get $4 million in interest, but it's only going to cost the company 3.8 million. And at the end of their 5-year term, 100 million and 100 million. And remember, this is twice a year, June and December. Now, if we accrue interest, which is a little bit different, because maybe they don't pay it out, they only pay it out once a year or during a certain period of time. So here you have a business that borrows on a 7% note September the 1st. So if you count the months from September through the end of the year, where let's presume their fiscal year is the end of December, you would have September, October, November, December. So that's 4 months. And so you would calculate the interest for those 4 months, and it's going to be 7 times this, which would be 8.4 million, but it's a third of that 8.4 million. That's where the 2.8 million comes from. And then when they pay the interest, they're going to do the accrual. They're going to reduce what they've accrued, this 2.8, and then they're going to have interest expense because we're following this principle called matching. And they're going to cash out 8.4 million. And then when they pay the note in 2014, it's going to be 120 million and 120 million. They're going to debit notes payable and credit cash. And we touched on the effective interest rate method. I just want you to read this slide. I'm not going to go through anything with this, but there's a graph on the next one. What the effective interest rate method does is it's a little bit better matching than maybe the straight line method. It's just a little bit more complex. And it's beyond the scope of this course, so we're not going to go through that. You have installment debt. And classic installment debt for you guys is going to be like a home mortgage or a car payment. And each period you pay both a principal and an interest. And what you'll find out is early on, the principal that you pay is going to be very high. I mean, very low, and the interest is going to be high. So if you owe, say, $50,000 in student loans, and your interest rate is 4%, in the first year, what they would give you, depending upon how long it's going to go, you're going to have to pay $2,000 in interest in the first year, and the principal will be very low. Now, when you get towards the end, say it's a 10-year amortization schedule, you're going to have next to nothing in interest and a significant amount of money in principal. And so the lesson there is if you are trying to pay a home mortgage or a car, particularly a home mortgage, what you need to do is pay more early on if you can. Even if you can add just another $200 or $300 or $400 a month for a home mortgage, it will make a significant difference and it'll reduce your principal fast in the early years. So if there's anything you can do to help you do that, that will help to reduce what you owe. What are some of the pros and cons of debt financing as opposed to equity, which equity is the selling of stocks and bonds, the selling of stocks? You have to take a look at it. One is that um, the interest that you pay on that is tax deductible for debt. It is not for equity financing like selling common stock. It also tells you exactly what you're going to owe, and that's a good thing. And it helps the business in that regard. Third, it helps in periods of inflation because there's periods of inflation you're paying back debt with lower dollar amounts. And the one negative is that there's an inflexibility. In other words, it's contractual. Even though it doesn't say it here, what I would really say is with equity financing where you sell stocks, you're not obligated to pay a dividend to your investors. Whereas if you do stock debt financing, you are obligated to pay a dividend. Leases, this is a kind of an interesting thing and can have some ethical dilemmas. There's really two types of leases, and you can read through all this, but let me illustrate it in a good way. Let's say you work at a business and you typically always use a scissor lift to get to the ceiling. And and you go to a local rent a center and you rent one and you use it for 2 months or 3 months, and then you take it back. That's going to be an operating lease. But if you habitually have a scissors lift at your facility and you are paying a company to use it all the time, and it's at a bargain price, but you know you're going to have it for an extended period of time, that's probably going to be a capital lease. And what makes the difference? The operating leases are expensed as you pay them each month, whereas a capital lease, you actually have to put a liability on your balance sheet. Now, there's certain rules in the bottom. You can read these. Leased asset lease occurs at the end of a lease at no cost or at a bargain price. So in other words, you buy it after the end of the lease term, you get to keep it and you have to pay for it, or it's a very low price. And the lease is for at least 75% of the economic life of the asset. So if you think that the asset's going to have an economic life of say 4 years and the lease is for three, it's probably a capital lease. And then the present value of the lease payments is 90% of the fair value of the leased asset. In other words, the net present value using present value functions, the value of that lease is um, is higher than 90% of what you could buy it for on the open market. There's some ratio analysis that gets done. You look at debt to equity. So this helps investors to try and figure out whether they want to buy something in a business. You have debt to total assets and long-term debt to equity. So all of these really are a measure of how levered a company is and what their debt structure is and if they can borrow money. And then a bank wants to know these times interest earned and times interest earned on accrual and on a cash basis. The reason they want to know these is to check whether you have an ability to pay back. There's some ethical decisions with some of this stuff. When you look at the solvency, that's a big thing. Solvency means that a company is going to be able to pay their debts and they're going to continue to follow. And it really has to do with how debt is reported on their balance sheet. And there's certain things that can be off balance sheet. There's something that's called a new pronouncement that came out a long time ago, but it's a function of Enron, which is probably in 2002. But it's called FAS 133. And what they want you to do is analyze all the off balance sheet financing stuff that a business is doing to make certain that it's all reported correctly because they don't want the financial statements to paint an inappropriate picture of what the sufficiency of the business is or a bad picture of the financial status of the business. So these are things that there's discretion in a lot of this stuff, particularly with long-term leases, capital leases and operating leases, and how it can be structured. And they can make them really, really complex to avoid some of the rules. And that can have some impact on how a business reports their financial statements. That concludes chapter 9. I look forward to seeing you in chapter 10. I hope you have a great day.